Every year, millions of people enter the market with a quiet expectation that within these charts, they will find the specific financial exit they have been looking for. They arrive with dreams of total independence, convinced that a few correct decisions will provide a life of absolute security. A beginner stares at a candlestick chart and sees a sequence of potential paychecks. Every green bar looks like a starting gun, and every breakout feels like a finish line that must be crossed at any cost. But for the vast majority, the euphoria is short-lived. Eventually, the screen goes dark, the capital is gone, and the trader is left in a silence that suggests they were simply never meant to survive this environment. Most attribute this failure to a technical mistake. They assume they used the wrong indicator, chose the wrong time frame, or lacked the right secret strategy to predict the next price movement. In reality, the barrier to entry isn't technical knowledge. The market functions as a psychological filter, designed to reward behaviors that feel unnatural and punish the exact instincts that help humans succeed in almost every other area of life. Survival in the financial world requires a total inversion of standard human behavior. To succeed here, you have to trade against the very instincts that normally keep you safe. Most believe that more effort leads to better results. In the market, this logic runs backwards. Hard work causes overanalysis, ambition prevents accepting small losses, and defensive fear forces you to freeze up when you should be acting decisively. Navigating this environment requires understanding three specific paradoxes. You must learn to find value in inaction, prioritize protection over profit, and recognize your own mind as your only true opponent. In a typical career, sitting idle for hours is seen as a failure of productivity. In professional trading, the most profitable move of the day is often the decision to do nothing at all. A surgeon does not perform an operation simply because the theater is empty. A pilot does not take off without a clear destination. Yet retail traders frequently enter positions just because the candles are moving and they feel a compulsive need to participate. This constant need for movement turns trading into an emotional addiction rather than a profession. The act of clicking a mouse provides a temporary sense of control, even if the underlying trade has no logical basis. This drive usually comes from a place of insecurity. It is a fear that if you are not active every second the market is open, you will miss the one chance you have to secure your financial future. Professionalism is measured by the number of trades a person has the discipline to ignore. The high-value skill is the filter, not the technical execution of the entry. Forcing a daily profit target compromises your ability to stay objective. When the market is quiet, the pressure to hit a number makes you see setups where none exist, leading to errors you would never make with a calm mind. A beginner asks how much they can earn. A risk manager asks how much they can afford to lose while still remaining capable of trading tomorrow. Placing capital behind a defensive shield allows profits to orbit as secondary outcomes. If the center is uncompromised, growth becomes a certainty. When risk is managed first, the account stays intact long enough for profitable moves to find you, rewarding your patience. Consistent growth is the side effect of capital preservation. By making survival the only goal, the financial results eventually take care of themselves. It is easy to view the market as a sentient enemy that is actively trying to take your money. But price action is indifferent. It has no interest in your specific position or your personal success. The professional environment is a neutral space of raw data. In this room, everyone sees the same numbers and the same charts. The only variable that separates winners from losers is the internal state of the person at the desk. The market acts as a mirror for your internal flaws. If you are desperate, you will see breakouts everywhere. If you are arrogant, you will refuse to exit a losing trade until it becomes a catastrophe. Fear and greed manifest as physical actions on the platform. You move a stop loss because you are afraid to be wrong, or you double your position size because a single win has made you feel invincible. The external market factors are secondary. The real struggle is the internal argument happening between your plan and your emotions every time a candle moves. Everyone knows the rules of disciplined trading. The gap isn't in understanding the concepts, it's in the ability to execute those rules when the pressure is at its peak and your account is fluctuating. Discipline evolves when rules become your identity. You stop trying to follow a plan and start seeing yourself as a person who simply does not deviate from their standards, regardless of what the market does. True control is shown in the moment of highest tension. It is the person who feels the panic of a loss, but still pulls their hand away from the mouse and closes the screen to protect what they have left. Being right about the market direction is a temporary win. Maintaining control over your own actions is the only victory that can be sustained for years. Success is the achievement of emotional autonomy. It is the state where your mood is no longer dictated by the closing price of a stock or the balance of your brokerage account. There is a specific peace in walking away from a volatile market, knowing you followed every rule. You may not have made $1 today, but you kept your discipline intact. And in this game, that is the highest possible profit. Self-mastery is the only prerequisite for surviving the market. Once you can control yourself, the market can no longer break you.